Good afternoon. The market closed Friday at a record high, and it is balanced on top of an oil shock. A war flared up again over the weekend, crude jumped, and tomorrow the most important inflation number of the month lands. Everyone is staring at that print, but here is the thing to actually watch. The single number that decides the next few years is not tomorrow's inflation report. It is the moment big tech's artificial intelligence build-out stops paying for itself and starts borrowing. And on the math, that quarter is right now. Let's get into it. Here's the board. The S&P closed Friday at a record, about 7,575, with the Nasdaq and the Dow both higher. Gold is near 4,100, caught two ways. Brent crude is near $77, up about 7% on the week on the war premium. Bitcoin is soft near 62,500. Now the numbers that matter most. The 10-year Treasury yield is about 4.56%, and the 30-year is above 5%. Records in stocks, sitting on top of a long bond that flatly refuses to price rate cuts, and the leadership is dangerously narrow. The biggest 7 companies are about a third of the entire index. A narrow market at all-time highs, walking into a make-or-break inflation number. That is a thin margin for error. Now the signature segment, consensus versus the read. First, and this is today's deep dive, everyone thinks big tech can easily afford the artificial intelligence build-out because they are the most cash-generative companies on Earth. But the affordability is partly an accounting choice, and it runs out this quarter. The profits that prove they can afford it are flattered by how they depreciate their chips. And this is not a theory, it is in the filings. Microsoft stretched the useful life of its servers from 4 years to 6, and that one change added $3.7 billion to operating income in a single year. Stretch the life of the gear, book less depreciation, report more profit, high conviction. Second read, everyone loves the memory supercycle, calling high-bandwidth memory irreplaceable with permanent pricing power. And the marquee event today backs the story. SK Hynix just pulled off a $26.5 billion United States listing, the biggest foreign public offering in American history, and it jumped about 13% on debut. But look closer. The memory makers have shifted about 93% of their output toward the artificial intelligence chips, and that is exactly why ordinary computer memory is suddenly scarce. A new federal antitrust lawsuit alleges they used that shift as cover to choke conventional supply, pointing to consumer memory prices up roughly 700% in 4 years. Sold out through 2027 is a top-of-cycle signal, not a flaw. Medium conviction. Third read, everyone thinks the record Bitcoin exchange-traded fund outflows mean institutions are fleeing crypto. United States Bitcoin funds bled about $4 billion in June, the biggest monthly withdrawal since they launched, and retail read capitulation. But over the same 2 weeks, large private wallets quietly accumulated about 270,000 Bitcoin, roughly $16 billion worth, and they bought it at a discount to the spot desks. Much of that outflow is a hedge fund trade unwinding, not conviction selling. The record outflow and the record accumulation are largely the same coins changing hands, not demand collapsing. Flows already flipped positive in early July. Medium conviction. Here is the tell, the single most revealing data point of the day. For years, the artificial intelligence build-out was self-funding. Operating cash flow dwarfed the spending, so it did not count. That era ends on the math right now. Capital spending is growing about 70% a year, while the cash the core business throws off is growing about 23%. This quarter, those lines cross, and the combined free cash flow of the biggest spenders touches zero. From here, every extra dollar of artificial intelligence spending is financed by debt, not by the printing press of the core business. When the most crowded trade on Earth stops paying for itself and starts borrowing, the question is no longer whether demand is real. It is who lends against profits that are 20% flattered. Follow the money. The macro regime is one feedback loop right now. Oil into inflation, into higher for longer, into pressure on everything long duration. The weekend's conflict and the threat to the Strait of Hormuz, about a fifth of the world's seaborne oil, rearmed the inflation tail at the worst possible moment, the week the market wanted a friendly inflation number. That is why the long end will not cooperate. The 30-year above 5% is the bond market saying it does not believe the disinflation story yet. The Federal Reserve is on hold, with about a 70% chance of holding again on July 29th, and an oil scare even had some traders flirting with a hike by September. The dollar is firm near a one-year high. That is the higher for longer tell. Gold is the quiet barometer of the whole regime. Spot sits near 4,100, caught in a two-sided tug. Safe haven buying absorbed the war-driven sell-off, while rising real yields, with the 30-year near 5%, are the mechanical headwind on an asset that pays you nothing. But underneath, the structural bid keeps compounding. Central banks have bought around 1,000 tons a year since 2022. And China's central bank just posted its largest monthly reserve addition in over 2 years. Pressured by the cycle, bid by the structure. On positioning, our market and social sentiment monitoring shows the mood split sharply bull versus bear into tomorrow's print, with dry powder parked on the sidelines rather than committed. Sectors in play: memory and semiconductors are the marquee mover. SK Hynix's blockbuster debut says the market still loves the high-bandwidth memory story, while the antitrust suit and the capacity shift say part of the shortage is manufactured. Own the secular trend, but respect that memory is where cycles overshoot in both directions. Mega-cap artificial intelligence, where the free cash flow crossover is the real test. With more than $700 billion of capital spending guidance under the microscope this month. And the banks. Second quarter earnings start tomorrow. JP Morgan, Goldman, Bank of America, Wells Fargo, and Citi. A higher for longer Federal Reserve is a tailwind to their lending margins, the exact opposite of how the rate cut crowd is positioned. On the radar, first tomorrow the June inflation report, the referee for the whole month. Consensus is around 3.9% headline and 2.9% core, but that is a forecast, not the actual number yet, and the core is what the Federal Reserve watches. The same morning, the big banks report. Later this week, producer prices, plus earnings from a SML and TSMC, the reality check on artificial intelligence chip demand. Around July 18th, the deadline for the new stablecoin rules, a crypto law that is really a giant new buyer of government debt. Then the Federal Reserve's preferred inflation gauge on the 25th, and the Fed decision on July 29th, where oil is the swing variable. For the scorecard, 3 new calls on the record. 1. The artificial intelligence free cash flow crossover is real and it bites. Over the next 2 quarters, at least one megacap prints negative free cash flow on a trailing basis, and the group keeps issuing debt to fund the build-out. 2. Memory is closer to a cyclical top than a permanent plateau. Within 2 quarters, at least one of the big 3 memory makers guides to slowing price gains or rising inventory. And 3. The institutions are fleeing crypto read is wrong. Bitcoin fund flows turn positive on a trailing 30-day basis within the quarter, confirming June was a trade unwind, not an exodus. We date them and we grade them. So here's the question worth sitting with. The whole market is staring at tomorrow's inflation print as if it decides the next leg. Maybe it moves a week, but the number that decides the next few years is not an inflation report. It is the one on big tech's cash flow statement, the quarter the artificial intelligence build-out stops funding itself and starts borrowing. Records get made on cheap money and self-funding growth. This build-out is finishing on neither. When the safest, most profitable companies in the world have to issue debt to keep spending, the right question is not, is the artificial intelligence real? It is, what does it cost to finish and who pays? That's the Daily Brief. Today's deep dive is linked right below. This is Earl. One contrarian read a day. Subscribe.